At some point during a bearish move, prices will start to resist further down moves. And when these moves are followed by an ultra-high volume bar, this is a very good signal to enter into a trade. When you see an ultra-high volume bar, something is going to happen in the market. A high volume suggests a high participation, a lot of interest in trading in that particular area, around that particular price. The question you must ask yourself is, why there are traders interested in participating in that zone? What are their intentions? To answer these questions, you have to analyze the volume along with the price action. It's about seeing what the price does with that volume. Today I will share a very powerful way to day trade, a scalping strategy more exactly, using ultra-high volume bars on the 1 minute time frame. So, like, subscribe, and stick around for the full video. Stopping volume is a well-known concept in volume spread analysis. It refers to a dramatic increase in volume that stops the market from falling further. This is your ultra-high volume bar, which appears after a downward move. There are many ways to integrate volume with price action, but I found that the best technique involves spotting extreme volumes. These signals are not frequent, but they are reliable, showing that professional money has stepped in and has taken an opportunity to accept the selling, usually from weak participants. One of the main benefits of volume is that it's a leading indicator, giving you early signals when the price movement is going to continue or reverse. One of the main principles involving volume is related to Wyckoff's law of effort versus result. This provides an early warning of a possible change in momentum. Divergences between volume and price often signal a change in price direction. For example, when there are several high volume but narrow range price bars after a substantial rally, with the price failing to make a new high, this suggests that we might have a change in the trend. This indicator tells us whether the volume is ultra-high, high, low, or average. It's called volume spread for VSA, and it's very easy to read volume using it. Red means ultra-high volume, yellow is high volume, green is average volume, and blue is low volume. You just need to focus on the red lines, because these are the ultra-high volume bars on the chart. Now, the scalping strategy involves fading the ultra-high volume. Here's the trading plan. The market is decreasing. Then, it experiences a significant surge in volume. This is when an ultra-high volume bar appears. After you spot the ultra-high volume, you find the candlestick associated with the surge in volume. Then you simply draw a channel from the candlestick's high and low price. In theory, the ultra-high volume should stop the price decrease. So the plan is to fade the downward move and buy if and when the price goes on the other side of the channel. Stop loss goes below the ultra-high volume candle, and the minimum target is a risk-to-reward ratio of 2. But the profit potential is much higher, as this might be the beginning of a new trend. When an ultra-high volume bar appears after a down move, what sort of price action should you expect? In the best-case scenario, it spots the end of a short-term bear trend. In this case, the signal will potentially lead you into the start of a bull trend. At the same time, a lot of trend traders will be trapped on the downside. At times, instead of preceding a bullish reversal, it pushes the market into a trading range. And of course, there's also the possibility that the market will continue to decrease despite the signal, implying powerful bearish momentum. That's why, to filter bad trades, it's better to draw the channel on the ultra-high volume candlestick and trade when there's some sort of activity to the upside. A narrow spread candle should have low volume. However, the ones that have high or ultra-high volume are special. This should instantly alert you. If you have a down candle with a narrow spread and an ultra-high volume, then the market is showing some signs of strength. As we know, high volume should result in a wide spread candle and not a narrow spread. Effort versus result. Wyckoff. The sellers are starting to struggle at this price level. Equally, if you see ultra-high volume on an up candle, then the reverse applies. Here, the buyers are starting to see signs of bearish sentiment enter the market. The candle is narrow, with sellers coming in and supporting the market at this level. Again, this is the first sign of a potential reversal from bullish to bearish. Future price action will confirm or invalidate this premise. A downward breakout below the ultra-high volume candlestick is your confirmation to enter short. We trade Visa on the 1 minute time frame. I see a range after the market opened and another down leg. As price was traded at the previous support, we see not one, but two ultra-high volume bars, and there are narrow spread bars. By spread, I mean the difference between the high price and the low price of the candle. We have our channel, which is right at the support, the ultra-high volume, after a down leg, and two narrow range bars. If price breaks the upper side of the channel, the plan is to go long. Stop loss goes below support, and we target the next major swing in the price structure. That's a risk-to-reward ratio of around 2.2. Remember, we are scalping, so we want to get in with a narrow stop loss and get out quickly. When you trade the 1 minute time frame, you will find many ultra-high volume bars, but you won't trade each signal you see. Focus on volume bars which stand out. Here we see a potential signal. We have an up leg, an ultra-high volume bar, and a narrow candle. A breakout below the channel with a very small stop loss, targeting the previous swing low, offers a decent risk-to-reward ratio of around 2. We have another signal, this time a potential long trade. I see a double bottom and an ultra-high volume bar on a narrow spread up bar. This isn't a textbook example because this is a green candle and not a red one, but we are still in a down leg, so if price is breaking above the high of the candle, I'll still risk a long trade, which indeed happens. Stop loss below the most recent swing low. Take profit at the next major swing. That's a risk-to-reward ratio of around 2.5. We'll use the same 1 minute time frame on Euro-Yen. We have a minor uptrend. And this is our ultra-high volume bar, which appeared on an average spread green candle. The plan is to go short, below the channel, if price breaks it. And here's our breakout. Stop loss above the channel, and take profit a few points above the support level. A risk-to-reward ratio of around 2. We move to pound dollar. we see an ultra-high volume bar at a London Open. The candlestick is a high spread one, so this is a high effort, high result situation, not the stopping volume we want to trade. This looks more like a continuation than a reversal. But if price breaks below the channel, we'll still risk a trade. Price indeed went higher and consolidated above the channel, so this was a no trade in the end. We have another potential signal here. I see a triple top, a major resistance, and a break of structure right here, which signals that sellers might be interested in pushing the market down. If you saw my previous video regarding the break of structure, you know this is a perfect opportunity to short the market. The signal came after the breakout of this candle. Stop loss, as usual, above the channel and above this previous high. As a side note, it gives me more confidence when I see that the signal appeared at a major intraday resistance. Take profit at the next swing low in the price structure. Again, a risk to reward ratio of around 2. Again, you are scalping, and if you are trading on a 1-minute time frame, there will be a lot of noise and many ultra-high volume bars, which might confuse you. If you are using TradingView, the 3-minute time frame is a decent alternative to filter signals. In this example, we see an intraday downtrend and an ultra-high volume bar. The signal appeared at the support level, so this is an opportunity to scalp a few points on the long side. Price breaks the upper level of the channel, and this is our signal to enter. Stop loss below this swing low, or below the low of the day, and we target this swing high. Unlucky, we lost this one. The main limitation of this strategy involves the market noise. To reduce it, and to reduce false signals, I advise you to trade ultra-high volume candles during active market hours. For example, if you're trading Forex, most pairs are traded the most between the time the London trading session begins and when the US session ends. Volume patterns you see forming during low activity periods, during Tokyo session for example, have a lower probability of working out successfully. If you trade stocks, you'll usually see several ultra-high volume candles right at the New York Open. I would advise you to avoid trading during the first 30 minutes after the Open if you're not experienced, and try to find volume spikes when volatility turns down. And I'll say it once again, location of the signal is very important. Look for volume spikes around support and resistance levels, supply and demand areas, Fibonacci levels, or near VWAP or common moving averages. These are the high probability signals which will bring you profits. As always, if you learned something new, drop a like to show your support. And check out our Academy program if you want to further level up your trading. Until next time.